Stop what you are doing for a moment, because the move we just witnessed in the precious metals market is the kind of moment that quietly separates informed investors from people reacting emotionally to headlines. Over the past week, something dramatic unfolded. Gold suddenly dropped around 3%. Silver collapsed even harder, plunging close to 11% in just a few days. On the surface, it looked ugly. Financial headlines quickly filled with words like correction, pressure, sell-off, and cooling momentum. If you glanced at prices quickly, you might have assumed something fundamentally broke. Maybe the rally was finished. Maybe the bull market was losing strength. Maybe the smart move was to step aside and wait. That reaction is completely understandable, because most people only see the price chart flashing red. But here's the part that most investors completely missed while panic started spreading across comment sections and social media discussions. At the exact same time retail traders were questioning everything, one of the largest global banks in the world quietly delivered a message to its wealthy clients that sounded nothing like the fear dominating the headlines. Instead of telling clients to reduce exposure or protect against deeper losses, the bank recommended something that might seem surprising if you only watch the price action. They advised investors to position themselves in a way that assumes gold and silver will not collapse further. In fact, they suggested strategies that actually profit if prices stabilize or move higher from here. That recommendation alone should make you pause and reconsider what really happened during this volatile week. Because when large institutions look at the same market move and come to the opposite conclusion of retail investors, something deeper is usually happening beneath the surface. By the time we walk through what caused the sudden drop, why it happened during rising geopolitical tension, and why institutional money appears completely unfazed, you may end up viewing this week very differently than you did when the sell-off first appeared on your screen. What looked like a warning sign might actually turn out to be something entirely different. It might have been the kind of pullback that quietly resets the market before another major move begins. To understand the situation clearly, we first need to examine the basic facts of what unfolded. During the past week, gold prices slid roughly 3%, while silver experienced a far more aggressive move, dropping nearly 11%. In precious metals markets, that kind of move can feel dramatic, especially for investors who recently entered positions expecting a steady climb higher. The confusion becomes even stronger when you consider the broader environment surrounding this price action. Today, the geopolitical situation involving the United States, Israel, and Iran continues to create uncertainty across global markets. Historically, moments like this have often pushed investors toward safe haven assets such as gold and silver. When tensions rise, when political uncertainty spreads, and when investors become nervous about global stability, precious metals traditionally benefit because they are viewed as stores of value during chaotic periods. That is why the recent decline puzzled so many people. If geopolitical risk was increasing, why were safe haven metals suddenly moving lower instead of higher? At first glance, it appears contradictory, but the mistake most observers make is assuming short-term price movement always reflects the true underlying fundamentals of the market. In reality, markets are often driven by temporary forces that have little to do with long-term value. Those forces can push prices sharply in one direction for a short period, even when the broader trend remains intact. One of the most important drivers behind the sudden selling pressure is something many retail investors rarely think about: futures exchange margin requirements. When volatility increases in financial markets, exchanges often raise the amount of collateral required to maintain leveraged positions. This technical adjustment can have enormous consequences. Traders who operate with leverage are essentially borrowing money to amplify their bets. When margin requirements rise, those traders must suddenly provide additional capital to maintain their positions. If they cannot provide that extra capital quickly, their positions are automatically liquidated. The key point here is that liquidation happens regardless of whether the underlying asset is fundamentally strong or weak. When a margin call arrives, the trader does not get to debate the market outlook. The position simply gets closed. When large numbers of leveraged traders face margin calls simultaneously, forced selling spreads rapidly through the market. That cascade can push prices sharply lower, even during environments where demand for the asset remains healthy. Silver is particularly vulnerable to this type of event because it historically attracts a large number of leveraged, speculative traders. Once forced selling begins, the effect can quickly accelerate. Each wave of liquidation pushes prices lower, which triggers additional margin calls for other traders who were barely holding on to their positions. The result becomes a chain reaction where selling feeds on itself. What begins as a technical adjustment transforms into what looks like a major market breakdown, even though the underlying fundamentals have not changed. Another factor that played a significant role in the recent decline is something called cross-asset liquidation. When investors experience losses in one area of the market, they often sell other assets to raise cash or reduce risk exposure. For example, if stock markets suddenly become unstable or volatile, Investors may choose to sell profitable positions in other markets to offset losses. Gold and silver are highly liquid assets, which means they can easily be sold quickly when investors need immediate cash. Even though these metals are considered safe havens over longer time frames, they can still experience short-term selling pressure during periods when investors are scrambling for liquidity. This phenomenon has appeared repeatedly throughout financial history. During major market stress events, investors sometimes sell everything that can be sold quickly. That includes assets they actually believe in long term. The strength of the US dollar also played a role during the recent move. Because gold and silver are priced globally in dollars, a stronger dollar automatically increases the cost of those metals for buyers using other currencies. When the dollar moves upward, international demand can temporarily soften because metals become more expensive relative to other currencies. This dynamic does not mean the intrinsic value of gold or silver has suddenly decreased. It simply reflects the mathematical relationship between currency movements and commodity pricing. There is also another subtle factor worth understanding. Markets tend to anticipate geopolitical risks long before those risks fully appear in headlines. The tension involving Iran and the United States has been building for a long period of time. Investors have been discussing the possibility of escalation for months. Because markets constantly look forward, some of that risk was likely already priced into precious metals before the latest wave of news appeared. When investors already expect a certain scenario, the actual news may not trigger the dramatic price reaction people assume it will. But the most interesting development of the entire week appeared when UBS released guidance to its clients. Instead of warning about deeper losses, the bank recommended that investors sell downside protection in both gold and silver. For people unfamiliar with options trading, this concept might sound complicated, but the logic behind it is actually straightforward. Selling downside protection essentially means betting that prices will not fall below a certain level. Investors collect premium income by taking the opposite side of someone else's fear that prices might collapse. Institutions only recommend this strategy when they are confident the probability of a major drop is low. According to the guidance, UBS believes gold is unlikely to fall below the level of $4,700 during the coming month. At the same time, the bank expressed confidence that silver should remain above approximately $65. That type of recommendation sends a powerful signal. It means the bank believes recent volatility represents temporary turbulence rather than the beginning of a deeper collapse. And perhaps the most striking part of their outlook is the long-term target they presented for gold prices. UBS indicated that gold could potentially reach around $6,200 per ounce over the coming months, as broader macroeconomic forces continue to develop. When you combine that projection with a recommendation to sell downside protection, it becomes clear that the bank does not view the recent decline as a structural breakdown in the precious metals market. Instead, the events of this week may represent something far more familiar to experienced investors. A temporary shakeout that removes leverage from the system, while long-term fundamentals quietly continue building beneath the surface. When you step back and look beyond the surface of the price chart, the behavior of institutional investors begins to tell a very different story from the one many retail traders assumed this week. While headlines focused on falling prices and dramatic percentage drops, the deeper signals inside the market were suggesting something far less alarming. Large financial institutions tend to evaluate markets through a longer lens. They do not simply react to a week of volatility. Instead, they analyze the structural forces that drive long-term price movements. And right now, many of those forces continue pointing in the same direction they have been pointing for years. UBS made it clear that their constructive outlook on gold remains intact. Their analysts highlighted several major drivers that they believe will continue supporting precious metals over time. One of the most important is the expectation that interest rates will gradually decline. Interest rates influence precious metals in ways that many investors overlook. Unlike bonds or savings accounts, gold does not produce interest income. When interest rates are high, investors often prefer interest-bearing assets because they generate predictable returns. But when rates begin to fall, the opportunity cost of holding gold drops as well. Suddenly, gold becomes more competitive because investors are no longer giving up large yields by holding it. That shift in relative attractiveness can quietly push significant capital toward precious metals. Currency trends also remain an important factor. UBS expects the US dollar to weaken over time as broader economic pressures develop. A weaker dollar typically supports gold prices because the metal becomes cheaper for buyers using other currencies. When the dollar declines, global demand for gold often increases. This dynamic has repeated itself many times throughout financial history. Precious metals and the dollar frequently move in opposite directions over longer periods. If the dollar eventually softens as many analysts expect, that alone could create a powerful tailwind for gold. Central bank behavior is another major piece of the puzzle. Over the past several years, central banks around the world have been accumulating gold reserves at an unusually aggressive pace. Governments have added thousands of tons of gold to their balance sheets. These purchases are not random. Many countries are seeking to diversify away from heavy dependence on dollar-denominated reserves. Gold offers a form of financial insurance that cannot be printed or devalued by any single government. That is why central bank demand has become such an important support for the gold market. Recently, reports indicated that central bank buying slowed from roughly 27 metric tons during an earlier period to about 5 metric tons more recently. On the surface, that decline might appear negative. Some observers immediately interpreted it as a signal that institutional demand for gold was fading. But there is another way to interpret the data. Central banks often accumulate gold in waves. After large purchases, they sometimes pause temporarily to digest what they already bought. They may also wait for price pullbacks before continuing accumulation. If prices suddenly drop during a volatile week, that environment can actually provide an attractive opportunity for large buyers who are waiting for better entry points. Silver has its own powerful set of fundamentals that extend beyond monetary demand. Unlike gold, silver is not only a store of value, it is also a critical industrial metal used in a wide range of technologies. Solar panels require silver to conduct electricity efficiently. Electronics depend on silver because of its exceptional conductivity. Medical devices use silver for its antimicrobial properties. Electric vehicles incorporate silver into numerous components. As the global economy continues investing in renewable energy systems and advanced electronics, the demand for silver keeps expanding. This creates an interesting dynamic in the silver market. Much of the silver produced each year is consumed by industry rather than stored as long-term wealth. Once silver is used in manufacturing, it often becomes extremely difficult or uneconomical to recover. That means a portion of the global silver supply effectively disappears from circulation over time. While gold largely remains in vaults or jewelry collections where it can eventually return to the market, silver is constantly being used up by industrial processes. That steady consumption gradually tightens available supply. The combination of investment demand and industrial demand can create explosive price movements when silver markets tighten. Historically, silver has demonstrated a tendency to move in sudden bursts rather than smooth trends. Long periods of sideways movement can be followed by sharp upward surges. Those surges often surprise investors who assumed nothing was happening because prices had been quiet for months. Another concept that becomes extremely important during weeks like this involves the difference between paper markets and physical markets. Most of the price movement people see every day occurs in futures markets. These markets allow traders to buy or sell exposure to metals without actually moving physical bars from vaults. Futures contracts can be created and traded extremely quickly. A trader can sell hundreds or even thousands of contracts within seconds, but moving physical metal across the world takes time, logistics, and transportation. Because of that difference, paper trading sometimes dominates short-term price action. Large waves of futures selling can push prices downward even when demand for physical metal remains strong. Over longer time frames, however, the physical market tends to exert a powerful influence. If industrial users, central banks, and investors continue absorbing physical supply, eventually the paper market must adjust to reflect the underlying scarcity of real metal. This relationship between paper and physical markets often creates moments where price and fundamentals appear to diverge temporarily. A week of aggressive futures selling may push prices lower on the screen, while physical buyers quietly take advantage of the dip to accumulate more metal. Experienced investors understand that these moments can represent opportunities rather than warnings. There are several indicators that investors sometimes watch to evaluate whether a price movement reflects genuine weakness or merely temporary market mechanics. One of those indicators involves the relationship between spot prices and futures prices. In a typical environment, futures contracts trade slightly above spot prices because buyers are paying for the convenience of receiving metal at a later date. However, when spot prices move above futures prices, a condition known as backwardation appears. That situation suggests immediate demand for physical metal is unusually strong. Buyers are willing to pay more to obtain metal right now rather than waiting. Another useful indicator involves lease rates, which represent the cost of borrowing physical metal. When lease rates remain low and stable, physical supply is generally plentiful. But when lease rates rise sharply, it suggests physical metal is becoming harder to obtain. If lease rates spike while futures prices decline, that combination can indicate paper selling occurring in a tight physical market. Premiums in major physical trading centers provide additional clues. Markets such as Shanghai or Dubai often display premiums over the international benchmark price when local demand is strong. If global prices fall but physical premiums remain elevated, it suggests the decline may be driven primarily by paper trading rather than genuine weakening demand. These structural signals are important because precious metals markets have a long history of shaking out impatient investors. Volatility can appear suddenly and force traders with leverage to exit positions quickly. Meanwhile, investors with longer time horizons often use those same moments to accumulate more metal at discounted prices. This transfer from weak hands to stronger hands repeats again and again throughout commodity markets. Silver in particular tends to move in ways that test investor patience. Its price can rise rapidly during bullish phases, but it can also experience dramatic pullbacks that feel uncomfortable even within an overall upward trend. Those pullbacks often occur precisely when sentiment becomes overly optimistic or when leveraged traders have built positions that become vulnerable to margin changes. The key challenge for investors is recognizing whether a sudden decline reflects a genuine shift in fundamentals or simply a temporary reset within a larger trend. That distinction cannot be determined by looking at percentage changes alone. Context matters. Understanding the underlying drivers of the move helps investors interpret volatility more accurately. During this recent week, many of the characteristics resembled a classic leverage flush rather than a fundamental breakdown. Margin requirements increased, liquidations spread across leveraged positions, cross-asset selling added additional pressure, the dollar strengthened temporarily. All of those forces can produce rapid price drops, even when long-term demand remains solid. Meanwhile, the institutions analyzing broader macroeconomic trends appear far less concerned about the decline. Their outlook continues emphasizing lower interest rates ahead, potential dollar weakness, ongoing central bank diversification, and strong industrial demand for silver. When those forces combine, they create a backdrop that has historically supported precious metals over extended periods of time. And that is why the guidance from UBS attracted so much attention among professional investors. When a major bank advises clients to position themselves in ways that benefit from stable or rising prices, it signals confidence that the underlying trend remains intact. Rather than warning clients to exit the market, they are suggesting ways to generate income while maintaining exposure to potential upside. Understanding that difference in perspective can change the way investors interpret short-term volatility. What appears frightening when viewed through daily price movements may look far less alarming when examined through the broader structural forces shaping the market. Now that we have walked through the mechanics behind the drop and the institutional perspective surrounding it, the next question becomes even more important. What happens next? Because markets rarely move in straight lines, and moments like this often act as turning points that only become obvious in hindsight. When volatility spikes and fear spreads through the market, investors are forced to confront one of the most difficult psychological challenges in finance. The challenge is determining whether a decline represents the beginning of a much larger collapse or simply a temporary shakeout before the next major move higher. Precious metals markets are especially known for creating this kind of psychological tension. Gold tends to move with somewhat steadier momentum, but silver behaves very differently. Silver often moves in violent bursts. It can climb rapidly, then drop suddenly, only to surge again when investors least expect it. That pattern has repeated throughout history. Long periods of quiet consolidation are frequently interrupted by explosive moves that catch many traders completely off guard. Because of this behavior, silver often forces investors to endure uncomfortable volatility before the larger trend becomes visible. Gold operates with a slightly different personality. While gold can also experience sharp corrections, it usually moves in smoother waves compared to silver. Those waves often reflect shifts in global monetary conditions. When economic uncertainty rises, when currencies weaken, or when investors begin questioning the stability of financial systems, gold tends to attract renewed attention as a store of value. These macroeconomic forces rarely change overnight. Instead, they develop slowly and influence markets over extended periods. One of the major themes currently shaping precious metals is the enormous expansion of global debt. Governments around the world have accumulated record levels of debt while continuing to run persistent deficits. Managing that debt becomes increasingly complicated as interest costs grow. Many analysts believe the long-term solution governments often choose in these situations involves lowering interest rates and expanding monetary supply. Those policies can gradually erode the purchasing power of currencies over time. Historically, environments involving rising debt and currency debasement have supported higher gold prices. Another factor worth considering involves how geopolitical developments interact with financial markets. Many investors currently believe that geopolitical risk is already priced into precious metals. The tensions involving Iran, the United States, and other regional actors have been discussed repeatedly in global news coverage. Markets generally attempt to anticipate risks in advance. Because these tensions have been developing for some time, traders may assume the potential consequences are already reflected in current prices. However, history shows that geopolitical risk can shift suddenly. Markets may price in the possibility of conflict, but they often struggle to price in the exact scale or impact of unexpected developments. If tensions were to escalate in ways that disrupt energy markets or global supply chains, investors might reassess those risks quickly. When that happens, safe haven assets can experience rapid inflows as capital searches for stability. Energy prices also play an important role in the broader inflation picture. If geopolitical disruptions were to push energy prices significantly higher, inflation expectations could shift again. That scenario might create additional pressure on central banks and influence future monetary policy decisions. Precious metals often respond strongly when inflation expectations begin rising faster than interest rates. Investors sometimes view gold and silver as protection against declining currency purchasing power. While these macroeconomic forces develop gradually, the physical flow of precious metals across global markets also provides important clues about underlying demand. In recent years, a noticeable pattern has emerged where large quantities of gold and silver move from Western trading centers toward Eastern markets. Cities such as Shanghai frequently display premiums above international benchmark prices when demand in Asia increases. Similar patterns sometimes appear in markets such as Dubai. These premiums signal that buyers in those regions are willing to pay more than the global reference price to obtain physical metal. Over time, this demand pulls metal away from Western vaults and into long-term holdings in other parts of the world. Once gold becomes part of central bank reserves or is transformed into jewelry or industrial components, it rarely returns quickly to global supply. The same is true for silver consumed in manufacturing processes. These flows gradually reshape the distribution of precious metals around the world. When investors in Western markets panic during price drops, the physical demand from other regions sometimes increases. Buyers who focus on long-term value may see falling prices as an opportunity to accumulate additional metal. That quiet accumulation does not always appear immediately in futures market prices, but over time it can tighten available supply. Understanding these structural dynamics helps investors evaluate whether short-term volatility reflects genuine weakness or simply temporary turbulence. During the recent decline, several signals suggested the latter interpretation. The selling pressure was heavily influenced by margin adjustments, leverage unwinding, and cross-market liquidity needs. Those forces can produce dramatic price swings even when underlying demand remains healthy. Meanwhile, institutional analysis continued highlighting longer-term drivers supporting precious metals. Expectations of lower interest rates, concerns about currency stability, persistent government deficits, and strong industrial demand for silver all remain part of the broader narrative. When institutions like UBS communicate confidence in those trends, their guidance carries weight because it reflects extensive research and market observation. The recommendation to sell downside protection illustrates that confidence clearly. Selling downside options means collecting income by assuming prices will not fall below specific levels. Investors who take that position benefit if prices stabilize or move higher. It is a strategy designed for markets where volatility has temporarily increased, but the overall outlook remains constructive. UBS indicated that they do not expect gold to fall below approximately $4,700 within the near-term horizon they discussed. They also suggested silver should remain above around $65 during that same period. When combined with their longer-term projection that gold could eventually approach $6,200 per ounce, their message becomes unmistakable. The bank is not positioning for collapse. Instead, it is preparing clients for continued upside potential while using volatility as an opportunity to generate income. That perspective invites an important question for individual investors. When markets experience sharp pullbacks like the one we just witnessed, how should investors respond? Some people react by selling immediately because falling prices create anxiety. Others interpret declines as opportunities to accumulate assets they believe will appreciate over time. The difference between those responses often comes down to psychology rather than intelligence. Financial markets constantly test investor emotions. Prices rise and create excitement. Then prices fall and create fear. Those cycles repeat endlessly. Investors who attempt to react emotionally to every fluctuation often find themselves buying near peaks and selling during temporary downturns. Long-term investors usually approach the market differently. Instead of focusing on every short-term movement, they concentrate on broader trends and underlying fundamentals. That does not mean ignoring risk entirely. It means understanding that volatility is a natural part of market behavior. Bull markets rarely move upward in straight lines. They include corrections, consolidations, and moments of uncertainty. Those moments can feel uncomfortable, but they are often necessary for resetting market conditions before the next phase of growth begins. When leverage builds excessively within a market, sudden declines can remove that leverage and restore balance. Once weaker positions are forced out, the remaining participants tend to hold stronger conviction and longer time horizons. This process sometimes clears the path for future advances. In the case of gold and silver, the recent week may eventually be remembered as one of those resetting moments. The selling pressure shook confidence among many short-term traders, yet the underlying macroeconomic forces that support precious metals remain present. Global debt continues expanding. Central banks continue managing complex monetary environments. Industrial demand for silver continues growing alongside technological development. Whether gold ultimately reaches the $6,200 level suggested by UBS will depend on how these broader forces unfold. If interest rates decline, if the dollar weakens, and if geopolitical uncertainty persists, the conditions supporting precious metals could strengthen further. Silver's combination of monetary and industrial demand adds another layer of potential momentum if economic growth continues, while investors also seek inflation protection. The most important lesson from this week may not involve any single price target. Instead, it involves understanding how markets behave during periods of uncertainty. Headlines often emphasize short-term price movements because they capture attention quickly. But beneath those headlines, deeper structural forces continue shaping the long-term direction of markets. Investors who focus only on daily fluctuations can easily lose sight of that larger picture. Those who step back and examine the broader context may interpret the same events very differently. What initially appears frightening might later reveal itself as a routine episode within a much longer story. The precious metals market has experienced many similar moments throughout history. Sharp declines have often been followed by recoveries that surprised investors who sold too quickly. Patience and discipline tend to matter far more than perfect timing. Investors who understand the structural drivers behind an asset are often better equipped to navigate volatility without abandoning their long-term perspective. As the market continues evolving, the coming months will reveal whether the recent decline was simply a temporary disturbance or the beginning of a larger shift. For now, institutional guidance, macroeconomic trends, and industrial demand all continue suggesting that the long-term narrative surrounding gold and silver remains very much alive.